Are you ready to unlock 15 life-changing money rules that can transform your financial future and set you on the path to financial freedom? Now, whether you're aiming to build long-term wealth, achieve financial independence, or create multiple streams of passive income, these rules will guide you every step of the way. And stay tuned until the end, because I'm going to reveal a critical financial secret, one that most people don't understand, and why it could be holding you back from creating real lasting wealth. So let's dive in with the first rule, which is to invest in cash flowing assets. Let me explain. Investing in assets that generate consistent cash flow is the foundation of wealth building. These assets can include rental properties, dividend-paying stocks, royalties, or even a small business. The goal is to have these investments generate income with little effort on your part. As you reinvest this income into more cash-flowing assets, your wealth will compound over time. So, as an example, if you purchased a rental property for $200,000 that generates you $1,200 a month in rental income, after expenses you might net £800 or $800 in positive cash flow. You can then reinvest this income in dividend stocks, creating multiple income streams that grow over time. Rule number 2 is to understand the power of compounding. Compounding occurs when your earnings generate additional earnings. The longer you leave your money invested, the faster it grows, making compounding one of the most powerful tools for wealth accumulation there is. This principle applies to stocks, bonds, real estate, and business profits, as long as the returns are reinvested. So, for example, if you invest £10,000 in an index fund with an annual return of 8%, after 20 years of reinvesting the returns, your initial investment could grow to more than $46,000 due to the exponential nature of compounding. That's why it was called the eighth wonder of the world by Albert Einstein. Rule 3 is to maximize time and resources. Time is your most valuable resource. You can never get it back. And leveraging others' time and expertise is key to scaling wealth. Instead of working for an hourly wage, build businesses or investments that allow you to earn passively or through others' efforts. This could mean employing others in your business or investing in assets that require minimal management. A small business owner might hire a team to manage day-to-day operations. The owner focuses on strategy and growth, leveraging employees' time to grow the business while reducing personal time commitments. Rule 4. Balance offense and defense in finance. Let me explain. Wealth building requires making more money, offense, and managing expenses, defense. Offense strategies include investing, side hustles, and career growth. Defense involves budgeting, saving, and avoiding unnecessary debt. A balance ensures that your income outpaces your expenses, allowing you to invest and save more. So, for example, a couple set a strictly monthly budget that includes investing 20% of their income in the stock market, while cutting unnecessary expenses such as eating out frequently or upgrading gadgets annually. This disciplined approach accelerates their savings and investments. Number 5. Understand inflation. Inflation erodes purchasing power over time, meaning money today is worth less in the future. To counter this, invest in assets that grow faster than inflation, such as stocks, real estate, or commodities. These assets increase in value over time, preserving and growing your wealth despite rising costs. So, for example, if inflation averages 3% a year, a £10,000 cash savings will lose purchasing power over time. However, investing that £10,000 in a diversified stock portfolio that grows at 7% per year means your wealth is growing faster than inflation. Rule 6. Distinguish between assets and liabilities. This might sound very simple, but actually it's worth explaining. Building wealth requires accumulating assets that generate income and avoiding liabilities that drain resources. Good debt, such as a mortgage on an investment property, builds wealth, while bad debt, like credit card balances for luxury items, destroys it. Always focus on acquiring assets that increase in value or produce income. So, for example, a person takes out a mortgage to purchase a £250,000 rental property which generates monthly income. Conversely, using a £10,000 credit card to buy luxury items that depreciate leaves them paying high interest without any income return. Rule number 7. Practice self-control and discipline. Financial success is more about controlling impulses than financial knowledge. Sticking to a plan, avoiding emotional investment decisions, and consistently saving and investing are more impactful than chasing quick wins. Discipline in budgeting, avoiding lifestyle inflation, and investing regularly leads to long-term gains. So, for example, rather than splurging on a new car after receiving a promotion, an individual sticks to their financial plan by investing the extra income in their retirement portfolio, compounding future growth instead of succumbing to a short-term desire. I could go out and buy a very expensive car tomorrow if I wanted to, but I'm very happy with our 6-year-old car as it is, and it's doing just fine, so why would I want to spend the money? Rule number 8. Embrace entrepreneurship. Owning a business is one of the fastest ways to build wealth. Entrepreneurs benefit from tax advantages, control over their income, and the ability to scale by leveraging others' time. While entrepreneurship involves risks, the rewards can be substantial, and owning a business provides multiple paths for financial success. So, for example, a professional with expertise in digital marketing starts a consulting business. After building a solid client base, they hire a team to handle operations, allowing them to scale the business and increase profits while stepping back from day-to-day work. Rule number 9. Optimise for tax efficiency. Taxes are often a major drain on wealth. Understanding and using tax-efficient strategies such as retirement accounts, tax deductions, and capital gain strategies can significantly boost your net returns. Minimising tax liability ensures that more of your money is reinvested and compounding in your favour. So, for example, a UK investor utilises an individual savings account, an ISA, I use these all the time, to invest up to £20,000 per year, where the returns are shielded from capital gains tax and income tax. This helps them maximise long-term growth without paying taxes on their investment gains. Rule number 10. Take calculated risks. Risk is inevitable in investing, but avoiding risk altogether limits your opportunities for growth. Wealthy individuals take calculated risks, evaluating the potential upside versus the downside. Diversifying investments, understanding markets, and making informed decisions help balance risk and reward. For example, an investor diversifies by investing into a mix of stocks, bonds, and real estate. While stocks are riskier, they offer higher returns, while bonds and real estate provide stability. This balanced approach manages risk while maximising returns. Rule number 11. Write down goals and act immediately. Wealth building begins with formalising clear, actionable goals. Writing down your financial goals and taking immediate action is crucial. Don't wait for the perfect time to invest or start a business. Success is about starting now and adjusting along the way. So, for example, a young professional writes down their goal of saving £100,000 by the age of 40. They immediately begin by contributing to a retirement fund, setting up a monthly savings plan, and take advantage of tax-efficient accounts to build towards that goal without delay. Rule number 12. Resilience after failure. Let's be honest, failure is part of the journey to wealth, but wealthy individuals use setbacks as opportunities to learn. Rather than giving up after a financial loss or a business failure, they reevaluate, learn from their mistakes, and press forward with a refined strategy. For example, an entrepreneur launches a startup that fails after 2 years. Instead of quitting, they analyse what went wrong, seek mentorship, and use their lessons to launch a more successful business in a different market. Rule number 13. Protect wealth. It is essential to protect wealth by avoiding unnecessary expenses and lifestyle inflation. As your income grows, resist the temptation to overspend. Instead, focus on preserving your wealth and living below your means, allowing for long-term financial freedom. So, for example, after receiving a promotion, an employee avoids upgrading to a more expensive lifestyle, instead increasing their retirement contributions and maintaining their budget, ensuring that new income goes towards wealth accumulation rather than luxury spending. Rule number 14. Minimize savings, maximize investments. And this sounds counterintuitive. While savings for emergencies is important, saving too much without investing can hinder wealth growth. Only keep enough savings for emergencies and bills, while directing the rest towards investments that generate returns. For example, a person keeps £10,000 in a savings account for emergencies, but invests an additional £30,000 in the stock market, earning much higher returns than they would have done had they just received bank interest. The final rule, rule number 15, manage expectations for financial contentment. Wealth isn't about how much you earn, but about aligning your financial reality with your expectations. People often push financial goals further, delaying happiness. Closing the gap between what you have and what you expect is the key to financial contentment. For example, a professional earning £80,000 a year feels dissatisfied because they expect to earn £100,000. Instead of focusing on that gap, they shift their mindset to appreciate their financial achievements, focusing on long-term wealth building strategies rather than on short-term income targets. By following these comprehensive investing rules, you can build a solid foundation for wealth creation, protect your assets, and ensure long-term financial growth and personal fulfillment. Now, here's the secret I promised. Cryptocurrency, despite all the hype, doesn't align with any of these fundamental wealth-building principles. It generates no cash flow. It offers no compounding opportunities, and it doesn't qualify as a reliable asset for long-term financial security. It's pure speculation. And while some might strike it lucky, it has no place in a solid long-term wealth-building strategy. Instead, focus on these proven methods that create sustainable wealth. If you found these tips valuable and you're serious about building long-term wealth, then make sure to like this video and subscribe to my channel. Hit the notification bell so you never miss out on life-changing financial advice. Thanks for watching, and I'll see you in the next video.